Hey guys, this is Jacob. So I just want to go over a brief video. I'll try to make it really brief. I got a lot to touch on though, uh, about investing in the marketplace for your future. So this here is a guy. His name's Timothy Sykes, and I mean I come across people, like they put stuff out there. You can go to his YouTube account as well, and he puts out videos on like how to basically speculate on penny stocks. He turned like $12,000 into $4.4 million. So I mean, he's legitimate. He'll let you know about it. I guess if you talk to him about it, he'll be like, yeah, I did that. And then this here is a guy, Martin Shkreli. Like he became famous for basically like some controversy with charging too much for uh, some medication, and his argument is basically like it costs a lot to make the medicine, and that's what we are. That's why we charge the they weren't making a profit, so they needed to make a profit so they can turn around and reinvest that profit in the company to make better drugs. And I understand the argument because I looked at their financial statement, and they weren't making any money. It wasn't the company's financial statement that he was involved in, but it was another one that he was involved in. I don't remember the name of it, but he's been involved in a few of them. But one of them was, they had their financial information out there, and I just looked over it just to make sure that he wasn't like making stuff up. And sure enough, like they were not making any money. Like their company that he was involved with was not. They were in the red. Um, so I'm sure that he had to just make a decision. I don't know why he didn't mention that, like, and just showed the statements to Fox News and just been like, listen, like, here it is, you know. But anyway, this guy, he's kind of a jerk. He is very arrogant, conceited, uh, but he does make good videos on like investing in finance. I'm not trying to make anything as in depth as he is. Uh, but if you want to learn like a lot about finance, like I'm sure a lot of people do, he got 112,000 views on his first video and 31,000 on his second video. But I mean, he's got like a good solid like 15, 16, 17 lessons. I stopped watching after lesson 10, um, or 12, I think. But he's pretty good. Like uh, he'll teach you like some good skills. And I mean, like, there's other people out there. Like this guy doesn't have anything, but I was reading a book about him. He's like referenced in a book. It was like a book on commodity trading, written a couple years ago. But this guy was up. He trades oil, and he basically betted that oil would go down in 2008, and he made 210% return. So if he had like $100,000, he would now have, 300 and uh, 320% return or something like that. I'm sorry, 320,000 or something like that. Uh, yeah, I think that's how that math works. But here's some other like important investors. Like a lot of them have books. Almost all of them have books on them and like how they did it. And like, like Michael Steinhardt's really good. Peter Lynch is really good. Warren Buffett's really good. Carl Icahn's really good. A lot of them are like older folks. So honestly, like, um, Jim Cramer runs the Mad Money show on CNBC, which is really good. He actually signed a contract that he's not able to trade in the markets while he's running that show. So he was actually up like a lot of percent, like when he was professionally investing. So for him to, turn on and make a show, and it's almost like he's like losing money to make that show. So, and because he just wants to help people and like get them some advice and stuff on like what to do with their money. So like a lot of these people, like they're just really talented, like intelligent people. They know how to buy and sell and like make a profit. So they want to just basically teach other people. Like this Robert Kiyosaki guy did Rich Dad Poor Dad, and that's very easy. Basically, like save your money, manage your expenses, invest in the future, and that's what we're trying to do right here. So this is a chart of like basically like U.S. inflation. Like we got inflation by year, so it's mainly up. So there's just inflation in this country. Like Like the value of your dollar is going to go down every day that you hold onto it. So it only makes sense to try to trade it for something else that is going to increase in value. And that's what the stock market is good for. See, like this is the consumer price index inflation. So back in 1999, something that was valued at like 165 is now going to be valued at $215, and that's just inflation. So, I mean, like honestly, like if you just buy gold and sit on it, you'd be better off. But we'll get to that in a second. So the Silk Road, they used that as a vehicle to trade. They traded like basic objects in Europe for stuff in China, and they made a profit, and everybody was better off. Like that's how it works. That's like economics right there. And then we got the East India Company. I was just looking up some stuff on them. They made 155% return in the first decade. So companies are profitable, and people involved in good companies, you know, there's profit involved. This is a market index for the S&P 500. I don't even use the Dow anymore because there's 500 companies in the S&P, and there's only like, you know, like 50 or 20 in the Dow Jones Industrial Index. I don't even remember, but it's a better market indicator because there's more. But basically, it's just a market indicator. We'll look at this later. It's very important that you understand the S&P 500 index and like, you know, just get a feel for like what these numbers mean and just kind of look it over. But here's gold. So like gold, like they took us off the gold standard like back in 1973 or 71, and Nixon did that because he's a crook. Anyway, you know, basically like this is a chart of the value of inflation in my mind. I mean, there's nothing else that really gold is useful for other than as a you know, like basically like if gold goes up, it's because the economy is going down or government or is causing inflation. If we have a strong dollar, the gold will go down. You know, if there's you know, market prosperity, gold's going to go down. Like that's just how gold functions. Because you can't print it, you know, so that's where it gets its value from. And then oil. So oil, you know, it's oil. You know, everybody uses oil for their vehicles and the economy. So oil crashed. You know, that Pierre Onderon guy, like this guy, like made a lot of money. This Pierre Onderon guy made a lot of money during this, you know, and you can see why. Like he betted at the top that it would go down, and you know, bought it back up at the bottom. So like, you know, people do this stuff, you know, people do it, and you don't have to be like, you know, so like a genius to do it. You just have to have good business sense. Here's financial visualizations. This is like a really good website for just screening stocks. It's a stock screening tool, and they you know, they'll tell you the top losers and the top gainers. I like to keep an eye on that because a top loser could potentially, you know, become a top gainer the next day. You know, you never know. You never ever know. And so I like to look at the top losers every day and just kind of filter them and just kind of look at their financials. But this is the first company I bought, NHTC. I bought it like, you know, back in May. It was like 30 bucks, and then I turned around and sold it at like 33 bucks, and I made a 10% return in like just a week. And I was like, wow, like I just averaged a year, you know? And so it was a good feeling. And I just found them using this financial visualization. Yeah, so the S&P 500, like this thing right here, it's supposed to average about 9% a year. So like from back in the day to like now, if you were to just buy it, you would get an average of 9% a year. So people like to use that as like a benchmark of like how good they did compared to everybody else, or like how good they did that year compared to the market, which is everybody else basically. So if you're above like 10%, like you are, I mean, if you're at 10%, you're average basically. If you're above it, you're like above average. So that's how you know. Anyway, that was a good one. You know, it went up to like $50 like a few months later, but you know, you can't get mad at yourself for missing things like that, you know? Like just be happy with what you get, because a lot of it is hard to predict. So there's MPG. This one went down in 2016, and I was looking at it, and I was like, like this is a new company. They have good, they're making money. Their income is up. So I bought it in November, and I bought it in September and sold here, and then bought it back up in November, and then I got hit like in early December. So I basically like broke even on this company, but I sold it here, and then I saw the market tumble, so I'm like, yes, I sold it. Like that was a good decision, and I turned around and bought it back up in like February, and got to ride like this little return right here, and that was good. And I ended up selling that, and I went long on SDLP Seadrill, because I saw this company. I'm like, okay, like they're making like 257 million a year. Their market cap, looks good. Their sales are really strong. So, I mean, everything's basically green on this company, and they just got cut in half. See, like, look at this. Like this company, it was at like $10 in December, and then oil price goes down. We see how in oil here, oil goes down around December of 2015. It went from like $60 to like 28. So we look here at SDLP, and it got cut like almost like, actually it was at like $12 back in like early 2015. So I mean, this company went from like basically like 12 or $10 to like $1 in February, $1.75 or something like that, and now it's back at 5. So honestly, like, I'm still holding on this thing. I bought it like right up in here, like in April, and sold it and like bought it back. And I mean, I don't know. I was just making a lot of decisions, but I'm gonna hold on to this company. I feel like SDLP is gonna go up for a little bit more, probably like to 650. I have a good feeling that that's my target price is 650. And then we have TVIX here. So this is important to know, guys, is TVIX. So TVIX works, it basically goes up in a down market, and it goes down in an up market. So, you see here, like in early 2016, this thing goes up. So when this one is going down, this one is going up. So it's a way to bet that the market is going to go. It's a way to bet that the market's going to go down, and you can just buy shares of that. It's not a company. See, there's no like information on it, but it's an ETF, and they're very important to know. All the ETFs, not all of them, but just like the ones that track gold and oil and the market, they're important to know. And this is dust. It's basically an inverse of gold. So if gold is going up, this sucker is going down. And gold's been going up since the market got bad. Remember I told you when gold goes up, that means there's something bad with the economy. So the economy starts to go bad, gold goes up, dust goes down. So this is something to buy if the economy is going good. Like if things are going to go good, you think they're going to go good, you want to buy dust. And then this is NUG. NUGGET is basically a bull. It's gold miners, a bull. A bear means something's going to go down. Bull means something's going to go up. It's just terminology. So basically, this is going up, and it's probably going to continue to go up. Honestly, like the economy is not going to be getting better anytime. It might go down for like a month, and then go up more. Who knows? But it's going to go up over the next year. It'll go up for sure. So a good term to remember is market capitalization. That is number of shares outstanding times their price. That is the size and the value of the company. So like Apple's worth billions because their market cap is billions. Net income is also a good one to remember. It's basically profit after expenses. So it's take home. It's what's yours. So a good way to value a company is by taking their net income and basically looking at the market cap and seeing how it compares to other companies within that same industry. So like tech versus another tech, or like an oil company versus another oil company. Return on assets is great. Investopedia is just great. Like honestly, like all right, we're done here today. Like get you a Robinhood account on your phone, and a TD Ameritrade account when you're done with Robinhood.